Okay, our department was asked to do a set of videos, and I did one a couple of weeks ago about the economic recovery, and it emphasised the importance of government spending as a way out of the importance of government spending, in relation to the COVID crisis. I put the link in the YouTube blurb below. But I got a lot of responses from people, from some of our students in particular, who are asking questions about, can governments spend infinite amounts of money? And that's a very tricky question to answer. It's a very tricky question to answer in 5 minutes, and there are people who are far better equipped, I think, probably to answer that question than me. But if I had 5 minutes at the end of a lecture, this is probably what I would say. So the question being, can governments spend infinite amounts of money? We should probably start with a slightly different question, which is, how do governments actually raise money in general anyway, right? And they raise government money through, three different sort of mechanisms. Through raising taxes, on individuals or corporations. For example, through cuts, and that kind of leads us back into the austerity discussions that, I talked about a little bit in the first video. And through government borrowing. Now, government borrowing is it's a contentious topic for a number of reasons. Number one is that over the last few years, last decade or so, we've kept on hearing that, in a sense, money doesn't grow on trees, right? We've been told again and again, attached to the austerity budget cuts, that basically, you can't live beyond your means. All sorts of household finance analogies have been applied to government borrowing as well. So government borrowing, the idea of governments borrowing to spend, has been a very contentious topic over the last few years. It's contentious for a second reason, because I think, location matters a lot. And that's part of what we're seeing now. That's part of the discussion that's going on in the Eurozone, for example, where, I suppose in really kind of crude, blunt terms, fiscal policy and monetary policy are separated, and governments don't necessarily have the same kind of powers that they do in places like the UK or the US or Australia or other places we're talking or we're thinking about in this little short video. And it's also, I think, contentious, the idea of government borrowing, because the kind of limits to government borrowing are very debatable. Now, I can hear some economists who might be watching this, or some economic students who might very strongly disagree with that. But I would go as far as saying that, that there are probably no clear objective limits to government borrowing. It varies a lot by time and place, depending on which kind of period of history you're thinking about and which country you're thinking about. And it depends in most cases on, confidence, right? And confidence is possibly the most debatable topic in economics, and we don't have time to go into that too much here right now. But in a sense, governments can borrow, and the version of that kind of government borrowing we're thinking about, or at least I want to in this short video, is what they call debt monetization. So in very kind of simple, crude, 3-minute versions, governments, if I want to go buy a new car, which I was planning to, but then COVID hit, and we'll have to see what happens to that. My car is probably going to die a death soon. But anyway, if I was going to go buy a new car, I would go take a loan, right, to be able to buy that car. I would borrow, in a sense, to go buy something, a commodity that I wanted to purchase. Governments do something very similar in a sense. Governments can borrow, but government borrowing tends to happen through bonds. So governments can issue bonds, debt, for example, and that's their way of raising revenue. Debt monetization it's a very debatable, very contentious topic for a number of reasons we don't have time to go into here. But the idea being behind debt monetization, the governments issue bonds, and then central banks, in a sense, create or issue new money and buy those government bonds. Okay, it happens already, right? It has happened for a very long period of time. But one of the things, and one of the reasons why it's very contentious, is a lot of central banks don't want it to be labelled debt monetization, because it comes with particular stigma attached to it. It's often thought of as leading to, government just excessively spending infinite amounts of money, which is kind of the question we're interested in here. But, central banks basically have said in the past, particularly in recent history, they've said, well, this is not a permanent feature, right? This is a temporary measure. the central banks are buying government bonds in the short term, but once the economy recovers, the central bank will offload those bonds off of our balance sheets, etc. So in kind of strictest terms, debt monetization is a permanent commitment by the central bank to buy government bonds, and central banks are obviously a little bit kind of skeptical about committing to that. But the thing I want to just focus on very quickly, in relation to COVID now, is why debt monetization, in my opinion, might be leading us into some kind of, or risk creating some kind of perfect storm. As I said, it's a very contentious topic, but pursuing this as a way out of the financial crisis. I feel like I've been reliving Groundhog Day for the last 10, 11 years, talking about the financial crisis all the time. But as a way out of the COVID economic recovery. So here's the perfect storm scenario that I think we risk seeing. Now, as central banks expand what's called the money supply, they, in a sense, if you like, create new money to be able to buy those government bonds. That has an effect on the economy, and it's complicated, and again, it varies a lot depending on time and place and things. But the risk, at least, is that it risks driving up inflation, right? So generally speaking, the prices of goods increasing. So, inflation tends to rise as the money supply tends to grow. And, traditionally, when inflation rises, central banks have one main response, which tends to be to raise interest rates as well, right? To rein in and to keep what they call price stability, to keep inflation rates at or around 2% in most of the Western world. Now, the effect of that, so inflation rising as a result of this, so central banks creating money to buy bonds, inflation rising as a result of interest rates being the kind of the normal response of central banks, well, that has an impact on the economic recovery as well. And that impact on the economic recovery could be quite severe in a sense for a number of reasons. So as interest rates rise, you can understand why certain firms will likely, unfortunately, go bust. Now, that happens under normal economic conditions anyway when interest rates rise. I think it's even more of a problem if we think about COVID and we think that, a lot of firms have borrowed quite heavily or will have borrowed quite heavily to pay wages or to furlough workers and things during this period. So if we think about that, we think that firms are going to exit the COVID episode more heavily indebted as interest rates rise in response to all of this stuff. That's going to have an impact by leading to some firms actually going bust. It's also going to have an impact, probably a negative, I would say, impact on the economic recovery in another way, because there are going to be some firms that survive the COVID recovery, but their main concern is going to be servicing or paying down their debts rather than investing and growing. Now, none of this is, my silly little arrows here, they suggest that all of this is one directional and really simple and straightforward, which it's not. But the trend and the pattern suggests to me that this kind of stuff, which would seem to be a logical way out of the immediate problems of the COVID crisis, is going to create other problems that may in turn weigh on the recovery. So here's my kind of prophet of doom, if you like, conclusion. It doesn't seem to me that there's going to be an easy way out. This is already, in a sense, what is happening. We're already seeing debt monetization happening, government borrowing and spending increasing. It doesn't seem to me that there's much of an easy alternative to that in the short term. But I think it's also worth bearing in mind that this is not simply one panacea. It's not an easy solution either. That economies in the past that have, quote unquote, successfully managed the process of debt monetization and some kind of economic recovery have basically relied on quite strong growth, whether that's countries like Japan, whether that's countries emerging after particularly the kind of First and Second World Wars and things. We're thinking about countries that saw, strong global growth. For countries, unfortunately, like the UK, we haven't even been thinking about the B word recently. We haven't even been thinking about Brexit and what is going to happen if and when we exit this COVID period. The global economy was already slowing. We talked about that in the first video. We're going to be hit again, most likely by the Brexit impact. All of these things are going to slow, I would suggest, the global economy and in particular the British economy. And so I think they're going to, in short term, in short and in closing, the two big actors that we talked about in the first video, the importance of governments in the immediate role that they're playing now and central banks, there are going to be big questions asked about them, about how they manage these competing forces, I think, after the COVID, in order to avoid my silly little downward arrow here.